everybody. This is Gary Dean with Sentiment Timing. You're probably scratching your head over the 2 years without a losing trade, and it is true. For the last 2 years, we provided members with trade alerts, and we have not lost a penny. Some of them were break even trades, but for 2 years we have not lost. So I've also been charting and trading the stock market for 25 years, so I have seen it all. So I have a little bit of experience in it. In 2013, I partnered with Woody Dorsey and we created Sentiment Timing, which is a highly regarded market timing service. So, have you ever wondered how some individuals consistently avoid losses in the stock market? They possess the ability to enter and exit positions effectively, even transitioning to cash when necessary. This skill isn't a mystery, it comes from understanding how to interpret chart patterns. So I'm going to be putting out these tutorial videos every week, and I'm going to be sharing my expertise, revealing the patterns and indicators that I use to precisely forecast the turning points in the S&P 500. And these indicators and chart patterns, they don't just work just for the S&P 500. You can use them for ETFs, for stocks, whatever you want. But the main thing is just learning how to use them. And that's what I want to be teaching you guys on a weekly basis. However, I do need your help and your support because I want to grow this channel to a huge financial community. The more people that subscribe to us, the more likes we get, the higher ranks we get in YouTube, which will then attract more people to subscribe and learn exactly what you guys are learning. So hit the subscribe button below, please. And when you do that, if you can take a link of this video and share it with your friends or family, anybody that's in the stock market that you think would benefit from this type of information, that would be appreciated. And what would even be better to help us grow it even faster is post it on Facebook and at whatever your social media is, because the faster we grow this channel, the more information that is going to be coming out to you, meaning that I may be doing nightly reports for you, so you know what's going to happen the next day. In the morning, maybe a morning update, and even midday if I see something going on, I'm going to be posting them in this YouTube. And if you're a subscriber, you're going to get an email from YouTube saying that we just posted a video, and you could jump on there, and they're going to be tradable, information that I'm giving you. It's not just going to be the tutorial; those are going to be on a weekly basis. So we really want to, grow this community. So I really would appreciate it if you would help us grow and share the link and this channel to whoever you know. So, and also as a token of my gratitude for subscribing and helping us spread the word. I'm going to be providing a PDF containing all my chart patterns I use, details about the technical indicators I employ, and instructions for setting them up. So click on the subscribe link below, get that free information, and without further ado, let's start this training class. Okay, so before we get into all the different chart patterns and indicators, I think it's good to give a little introduction to technical analysis for anybody that's really not that familiar with it. So, technical analysis is it's basically the essential tool for traders seeking to navigate the dynamic financial markets. Technical analysis involves the study of historical price data, chart patterns, and key indicators to forecast future price movements. By understanding and applying technical analysis concepts, traders can make informed decisions, manage risk effectively, and increase their chances of success. So this is why it is really important to know and understand what technical analysis is. A lot of people go off of fundamentals and stuff like that, but the charts always seem to lead the way. And even though I'm not a fundamental trader, with price to earnings and all that. I think I've done pretty well just trading off of the charts. And that's really what I want to really teach you guys in these videos. So let's get to the different patterns. In the realm of technical analysis,
Chart patterns play a crucial role in analyzing and predicting price movements. These patterns can be classified into two main categories: reversal patterns and continuation patterns. Reversal patterns suggest a potential trend change, indicating that the current trend may be coming to an end and a new trend is likely to emerge. On the other hand, continuation patterns imply that the prevailing price trend will continue after a period of consolidation or sideways movement. These patterns provide valuable insights into market dynamics, allowing traders to identify potential entry and exit points based on the anticipated direction of the price trend. By understanding and recognizing these chart patterns, traders can enhance their decision making process and improve their overall trading performance. There are a ton of chart patterns which I will cover, but in this tutorial, I am going to go over the power of the triangles. Triangle patterns are continuation patterns. Triangles are important continuation patterns in technical analysis that provide valuable insights into ongoing price trends. Traders should closely examine three distinct types: ascending triangles, descending triangles, and symmetrical triangles. Each type has its own characteristics and implications for future price movements. A symmetrical triangle exhibits converging trend lines, indicating a period of indecision and potential volatility. An ascending triangle features a flat resistance level and a rising support line, indicating a potential bullish continuation. Conversely, a descending triangle shows a declining resistance line and a flat support level, suggesting a potential bearish continuation. By thoroughly analyzing these triangle patterns, traders can enhance their understanding of market dynamics and make well informed trading decisions. Let's take a look at the symmetrical triangle. The symmetrical triangle, often called a coil, is a chart pattern that typically emerges as a continuation pattern within an existing trend. This pattern is characterized by a series of at least two lower highs and two higher lows. When these pivot points are connected, the lines converge, forming the distinct shape of a symmetrical triangle. Visualizing it, you can imagine a contracting wedge that starts wide and gradually narrows over time. The symmetrical triangle pattern suggests a period of market consolidation and indecision as buyers and sellers reach equilibrium. Traders closely monitor this pattern, anticipating a potential breakout in price as the triangle pattern reaches its apex.
Here's a chart of the symmetrical triangle. As I explained above, it starts out wide and then it gets closer and closer, almost like a tweezer. And the way this works, it starts here. Here's your one. This was a one on the top. We had a two, two on the top, three, and then three. So the way this pattern works is that you trade whichever way it breaks out. So in this case, it broke out to the upside. Now, what the pattern target is, it's going from one to two. That's $5.80. This is on Sun Micro. And you can see right here when it broke out, it went almost exactly up to the $5.80. So the good thing about this pattern is that if it breaks to the upside and you get long, you can simply put your stop at number three here, and you're risking a couple points, maybe $1.50 on the trade, but your reward is going to be $5.80. So the risk reward on this particular setup is very good. They're very reliable, and a lot of traders use them to make quick trades. Because typically after the triangles, they'll start to consolidate again and either top out or just go sideways. But this is a continuation pattern, and this is a symmetrical triangle.
The ascending triangle is a notable chart pattern utilized in technical analysis to analyze price movements. It emerges when the swing highs form a horizontal line, while the swing lows are connected by a rising trend line. These two lines converge to create a triangular shape. Traders actively monitor ascending triangles for potential breakouts to the upside, as they can indicate significant shifts in price direction.
Now let's take a look at an ascending triangle. Ascending triangle typically means it's going to be breaking out to the upside. And the reason why is you can see you have higher lows and higher lows. So you have this uptrend line going here. And when it hits resistance, it's pretty flat. So this is your ascending triangle. But what happens is eventually it breaks out to the upside. So when you see this pattern in play, typically you're going to be looking up, not down on it, because it's a continuation pattern. Now, one thing to be aware of is if a pattern like this fails, because people get trapped when a pattern like this is setting up and they're buying the dips and they're getting all excited for the breakout and it ends up not breaking out and breaking down. This is typically what will happen is you have everybody buying, and then it breaks to the downside instead of the upside, and you get a failed pattern that actually would have been the same amount of distance on the upside as it is the downside. So you want to make sure that when it one is that the actual it breaks out, and two is when it breaks out, you need to put a stop in place, because if it fails, this is what's going to happen. You're going to get the same distance that was going to be up to the upside, but it's going to be to the downside. But the ascending triangle is a bullish pattern.
A descending triangle is a bearish chart pattern that consists of a downward sloping upper trend line and a horizontal lower trend line, which acts as a support level. This pattern suggests that sellers have greater control over the market compared to buyers, as the price forms lower highs. The descending triangle pattern is considered complete when the price breaks out of the triangle in the direction of the prevailing trend, indicating a potential continuation of the downward movement. To identify a descending triangle pattern on charts, follow these steps. Downtrend. Confirm that the market is in a downtrend before the descending triangle pattern emerges. It is important to recognize that the pattern should not be traded solely based on its appearance. Consolidation. The descending triangle pattern forms during a consolidation phase when the market temporarily moves sideways. Upper trend line. Draw a downward sloping trend line by connecting the highs of the consolidation phase. This trend line demonstrates the gradual downward pressure exerted by sellers, strengthening the bearish bias. Lower trend line. Identify the lower trend line, which acts as a support level. Price tends to approach this level and bounces off it until the eventual breakout occurs. Trend continuation. Once the price makes a strong break below the lower trend line, traders should look for further confirmation of the pattern through continued downward momentum. By following these steps, traders can effectively identify and utilize the descending triangle pattern when trading. Remember to combine it with other technical indicators and consider the overall market context for comprehensive analysis and informed trading decisions.
Okay, so let's take a look at the descending triangle. Now, this is a bearish continuation pattern, as the description of the descending triangle just explained. And here you can see this is the S&P 500. It's only on a 15-minute chart, so this is actually would be more just of a trade. But in the upcoming videos, I'm going to go over how I determine the, let's say, bigger picture direction, meaning that could be months, could be years out, and then narrowing it all the way down to a 60-minute chart. So there's a lot I'm going to be covering in these videos in the coming weeks. And but for this one, this is the descending triangle pattern. And here you can see we're making lower highs. Every time we came up, the bears would step in and push it back down. But every time we got to this support level, the bulls would step in and push it back up. But this is a bearish continuation pattern, so the expectations is that it's going to move to the downside. And if we look and see what happened, here you can see once we broke through this support level, this was the trigger on the trade. You put your stop up here, and this was the actual distance. It was going from this top to this bottom. If we just measure that and put it here, so the trade was for a move going down to 40.26, and that's from the 40.94. So about a 70-point move. And you can see we continued down after that. But the particular pattern that we're looking at was for this particular move. And this is the descending triangle. Now, again, in the the next videos, I'm going to show you how I combine all of these the indicators to really let's say confirm the pattern breakdown or break up, because we should be going off of either some bullish or bearish divergences. And again, that's exactly what, how we're going to be trading these things and what I'm going to teach you in the coming weeks. So this is the descending triangle, and that's how you trade it. So that's the conclusion of the power of the triangles. I hope you guys enjoyed it. And I just understand that this is the first video that I've done. So it took a pretty long time to do. I think the next ones are going to be a lot easier for me to put together. And what I'm going to be doing, like I said, on a weekly basis, putting out, informational videos like this to help you guys self trade. And the next one I'm going to do is it's probably going to be next week, and I'm going to be adding in technical indicators into trading chart patterns. So I'm going to add a couple new chart patterns that I follow, and on top of that, I'm also going to be doing the indicators and showing you what I look like. And then in the next week or two, I'm also going to be putting together how to look at something from a longer time period, meaning that what to look for from a monthly, weekly, daily, and then going all the way down to a 60-minute chart. So you know exactly when, to be entering or exiting a stock, an ETF, that's going to give you the greatest the chances of making money and limiting your risk. So hopefully you guys enjoyed this. If you can please do me a favor, hit the subscribe button, hit that little yellow bell, because that's going to alert you with any upcoming videos that we do. And I'm going to be doing them, like I said, on a weekly basis. And I have down that I'm going to be giving you guys the indicators that I use, and that's coming. I'm still putting everything together, but please just hit the subscribe button. Take this link, share it in your social media, and let's try to grow this community as large as we can. So, with that, thanks for watching.